Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Thursday, August 23rd, 2023. It's 3:30 p.m. as I'm starting the video. Just walked in the door at a doctor's appointment this afternoon. It went forever, a lot longer than it was supposed to go, but I'm back, and I just wanted to get one out before the close. So I'm going to talk quick, cover just the key stuff that I'm looking at here. This is QQQ. We had that what I call an ADH, almost divergent low. Talked about it the other day. We took out the divergence. Nothing's changed in my long-term view. Near-term, you still have this, maximum, what I call maximum bounce target zone. It was the bounce target zone before when we had the divergence back here last week, and late last week and early this week. And so that's it. You can see in the video the other day, I colored up the lines to highlight those levels, 371 roughly and 375. Very relatively, again, like I talked about the other day, from this level here, it was and is still only 1.7 up to about 2.8%. So relatively small area. And now from where we're at now, we're effectively there, again, effectively for all intents and purposes, close enough to that 371.17 level. And so nothing has changed. My long-term, intermediate-term view, NVDA reports tonight. That is by far the undisputed king and poster child of the AI hype. So that has the potential, depending on how that stock acts going forward. Definitely more important tomorrow, how it finishes the regular trading session and into the coming days next week. But of course, we'll see what it does after hours as well. So a NVIDIA pop would bring the Qs up here, if it's a pretty good pop, into that range. And that would be, as I mentioned before, when we get there, a very objective level to either initiate or add to any shorts if you've been scaling into shorts. And if you're long, this is my no-go zone up here for adding. If we take that level out, then at that point, not only would this is just me talking, not only would I not add to any more shorts, it's only longs at that point, because it would increase the odds, in my opinion, of extending the divergence out. Talking about this divergent high we put in recently, any pop above there, if we take out this minor downtrend line and that pretty significant resistance around 375, probably cause a little spike up there, which again, as I've talked about, would simply extend the divergences that are currently in place because these indicators are lagging. But we'll see. Apple, of course, that hit I got that one out to you before I left today. Hit that, there's two bounce long targets, but it's, this stuff gets confusing if you're not an active trader, don't catch up on the site regularly. I still maintain these targets, T1, 2, 3, and most likely I'll scratch that. If we get anywhere down, if we break this level here, we break Friday's lows, as I said in yesterday's video, and I believe the day before, not Friday, I'm sorry, I'm talking fast trying to get this out there. Yeah, it is Friday's lows. We take out Friday's lows or the recent lows in QQQ, SPY, and most of these market leading stocks. I believe that will open the door for the next leg down. I think it'll be a relatively swift leg down, in my opinion. And then it's going to increase the odds. We're going to keep going down and hit these additional targets, at which point I will, and that'll increase the odds of this potential T4 being hit, and I'll extend that target. And remember, this is just a 60-minute chart, long-term charts. Nothing's changed. I still have some much more aggressive, much lower targets on Apple and the market as well. So just near-term stuff. Here we are. Apple hit that support this morning. I'm sorry, resistance, about 181 and change. And it's been trading on it all day. And that's what a reaction is. A reaction is when you run into a resistance level from below, or an area. That's why I list these multiple targets. It's where you expect a reaction. And I define that as either a reversal off that level or a consolidation. In other words, you stop. So I use that whole hacky sack versus golf ball or tennis ball dropping it on a hard floor analogy, where the hacky sack's just going to boom, hit the floor and stop. That's that kind of reaction there. And the tennis ball or the golf ball will bounce. or in this case, if you throw them at a ceiling. Anyways, gravity's going to pull both down, so forget about what I just said. Just keep with that floor analogy. All right, so there it is, Apple at resistance. QQQ coming up on resistance. NVIDIA reporting tonight. I will put good money we're going to see a fade from where we're at right now. By the time you get this video, probably some profit taken from short-term traders. That would be my best guess. And then where NVIDIA goes from here, I already covered that yesterday. Like I said, it's in spitting distance, or really, you know what, it actually did put in just yesterday a divergent high, an additional, it extended the divergences as I covered. So we already have that, but the point I was trying to make yesterday, and I'll still make today, is that any marginal new high, as long as it's not, 20%, 15% too high up there, as long as these divergences are intact, meaning you don't violate or move past these previous reaction highs, you're going to have big negative divergence. And so to me, it's almost coin toss odds whether you're going to get this and then that, and coming down to that downtrend line, which is my next target right here, about 317, and this primary uptrend line, or whether you're just going to do that. Okay, so that's where I'm looking at. So therefore, we'll see what NVIDIA does. No reason to go home aggressively long or short anything that's due to, even remotely related to tech or AI, or the NASDAQ, which is a tech-heavy index. So that's that. Let me look at, because I haven't since I walked in the door, the semis. Semis are really close, and I think we may have gotten to that 507-ish level. That was a pretty significant support level, and I mentioned that would be an objective level to add to shorts. You get a potential bullish PPO crossover coming up, but it's only potential at this time. It hasn't happened. We'll see if it does, but I still maintain more downside in the coming weeks to months. So this will bounce, by the way. This, if the NASDAQ bounces, and of course NVIDIA being the largest by market cap, by far the largest chip company, that's going to impact this. So I think it's a crapshoot to go home long or short, especially heavy long or short stocks. You can always wait to see which way this one breaks, and if it pops up, same story here. Any new high anytime soon like this is going to be a divergent high due to how badly these indicators are lagging. So that is my most optimistic scenario for the semis. They put in a marginal new high. It's still longer term bearish if it plays out as the way I suspect it would. So that's that. Two quick updates. Silver, I got one out to you this morning. Silver, we had that hit that target, the downtrend line, but gold just broke out, so that divergence is certainly playing out. Like I said, just raise stops if you're holding out for additional gains. If you did that yesterday, remember I said the odds were elevated for a reaction. This was my first target, 21.49, as I covered in yesterday's video. It just exactly what Apple did today. These are 60-minute candles. 1, 2, 3, 4, 5, exactly on that level. That's a consolidation. And then silver futures moved overnight. And so had you raised stops to protect profits, you'd still be in this trade. And you could do the same thing now. Let me show you what gold and the euro look like, because they're all related. And then I'll get to treasury bonds, and I will try to wrap this video and get it out to you. So there's gold. That was also highlighted as a trade idea the other day. There's your breakout candle. First target hit, second target effectively hit now, possibly bull flagging. Positive divergence was a reason for going long gold and putting that one out the other day. And a really nice target. You have this downtrend line plus a price resistance right here, a zone from about 180. We'll call it 180. That's 179.78 and 180.14. Split the difference, call it 180 is your next resistance. But this is resistance. This was a target that has been hit. And that's going up because, and as is the stock market, because of the euro. I've highlighted the very tight positive correlation between the euro and both gold, silver, the precious metals, in other words, as well as the stock market. So there's the euro. It keeps making these divergent lows. It hasn't been playing out for a rally. It's a little pop, but they keep selling. We've had these divergent lows. The euro just continues to get sold into. However, what happens, sometimes these divergences grow, and then they finally play out for a much bigger move. So that is, make no mistake about it, this spike up today is not mere coincidence. The gold, silver, and the stock market are up. And then and where it goes from here, like I said, there's some price support right there. Longer term, it looks like more downside to me based on the scope of these divergences and everything that happened there. But we'll take it kind of day by day, watching the 60-minute charts. I think that's a better way to do it right now. Finally, Treasuries. I'm going to make sure to get that one out to you today. Throughout Treasuries as a long trade idea on Friday. They've been moving up since. That means yields have been falling. This is what was putting pressure on the stock market. So as I said this morning, I upped my my longs in Treasuries considerably for two reasons. Number one, here, let me just go to IEF for you. There's the yield. TNX is the 30 or the 10-year yield. There was that wedge breakdown, negative divergences. That was just IEF in reverse. IEF is the 10-year Treasury ETF. I threw it out to you here. Continues to move up. Positive divergence. And so it is far from mere coincidence that Treasury bonds are rallying today. That's because, of course, the yields are down, and that's why the stock market's rallying. So as I said, watch Treasury yields closely. The market is hyper-focused. Any upside, if we do this anytime soon, take out these lows, you're going to have the 10-year already kissed its multi-year. It reached levels not seen since 2007, right before the great financial crisis, right around the time the last big bear market started in 2007. And so this will be, I can all but guarantee you, the stock market will go down if we take out these lows. As of now, it's a constructive chart. So I view this as twofold. And I told you today I also took some ZB, which is a 10-year Treasury bond, the 30-year Treasury bond futures. And I mentioned you can, if you're an ETF trader, TLT is your comparable ETF. And you can see same thing, bullish falling wedge. So first and foremost, the charts were constructive. I will never take a trade if the charts don't say take it. So it's a pure play long in Treasury bonds right now, just looking for a counter trend bounce, rally these 60-minute divergences. But it also is an offset to, I told you the other day, I started scaling back into short positions after, shortly playing a little bit of a long bounce, which is carrying forward today. And like I said, we may have a little more upside on that. So my logic is it's I think at this point in time, a good hedge. Treasury bonds and stocks were highly correlated when the market peaked back in late 2021, early 2022. Both Treasury bonds and stocks fell together, and they even had the counter trend rallies. However, right now, I'm looking at they've been off and on since, but I'm looking at a pretty tight correlation now is my expectation. Why? Because again, what I just said, if interest rates tick down, and because the market right now is hyper focused on interest rates, any reprieve, meaning rates drop, which means bonds rally. So therefore, to be short equities and have an offsetting position, now you're going to have to at least double your position size, net exposure, whether you're using futures, you can calculate, what the numbers are, or ETFs. So in other words, if you were short QQQ or SPY for the 50,000, then you're going to have 100,000 long plus in TLT, because as I said, it moves up and down, typically a lot less than the stock market. So I usually give it around a 2.0 beta adjustment, meaning twice a typical position on the SPY or the S&P 500. And so that's it. So right now it's a pure play, and at some point soon I may likely close this one out and go to again, I don't want to call it a pure, I'm not only using this as a hedging tool, but it is effectively that. And so if QQQ gets up to that bounce target zone right here, then, and I can make a decent case to book profits on the Treasury bonds, then that's what I'll most likely be doing. And then I'll be, let's just say, unhedged on the short side if and when we get there. So, all right, hopefully that makes sense. I know there's a lot of moving parts to a trading plan. I told you many times in the past, I don't take direct hedges. In other words, if I'm long QQQ, I don't short QQQ, especially, in that account or even in another account, if it's on the same time frame, a swing trade. I'll just close out QQQ. Or what I like to do more often is take an indirect hedge, something because if I'm really lucky when I do that, if the charts are a support being, let's say, short QQQ and long treasuries, then I can actually make money on both. That was the case yesterday. Qs were down, I believe it was yesterday, and treasuries were up. So anywho, that's what I'm looking at. What else did I leave out? USO. I got a few out to you, the relevant ones this morning. That's usually how I work. If something is actionable, I'll fire a post off so you can decide to act on it if you will. So we hit T2, just like when we hit T1. Again, this is why I list multiple targets. If you're an active trade, you hit T1, you bounce. Went through it, recovered it, a little more bounce. There's that downtrend line. So these are your salient levels. The downtrend line, T2 was hit. There's the reaction. Provided an objective short re-entry. It bounced up back to very close to T1. And you can see that's resistance. And the way it works is now that was an objective short entry. I was unfortunately away from my desk earlier today when that happened. If and when it takes out today's lows, that should open the door to T3. Just like in summary, to wrap it up here, we take out Friday's lows in QQQ and SPY. This is SPY, which is also right at resistance. I tell you right now all day long, that's good for at least a pullback trade in SPY right here off that level. And QQQ, like I said, Apple's at resistance. That's me fading this rally make what I'm going to fade. I'm going to cover before NVDA reports, but still I'm going to take home. I'm going to stick with those shorts. Again, I mentioned they're just starter shorts I started scaling back into, and I am going to allow for it. I was debating whether to just stop out here, but I'm going to keep those swing positions on short up to, but not above this level, and look for the next leg down. So now NVIDIA can all may change that. I'm going to stop this video right now. I don't know if I can get it processed, uploaded to YouTube and out to you, but I'm going to do my best. And again, I thought I'd be home earlier to get this one out, and rushed home, and here it is for you. Okay, guys, I'll get it out to you, and we'll pick it up tomorrow, depending on what NVIDIA does. And again, don't read too much into the initial reaction after hours, even if it's big one way or the other. It really matters how it trades tomorrow, especially how it closes the day. Okay, this has been Randy Finney with Right Side of the Chart. Have a great day.